what the delta ultimately is the net interaction between buyers and sellers. In other words, as price rises, if we have a positive delta, in other words, there is more offers being lifted out of the market than sellers hitting into bids. In other words, we can see that there is a lot of offer being lifted as the market rises. Now, that doesn't mean that price will keep rising. It's just telling us about the interaction or the level of interaction taking place. Okay? Now, what the cumulative delta is doing is it's telling us over a course of a day, over a period, how much accumulation in interaction is there. Because what will typically happen, and the best way to think about this is on a trend day, what will typically happen is we'll have one directional price bias, where price goes in one direction only. But ultimately what will happen is over the course of the entire day, there will be people providing liquidity on the way up, but it just keeps getting lifted. Okay, and that's why it's so strong. That's why it's so one directional, because it's just so much buy volume. Whoever dares to provide liquidity is going to get lifted out of the market. Okay, so what happens over the course of the day is anyone that tries to sell is going to be lifted, and that interaction or that delta pretty much just trends positive all day. Okay, this is a very, very common characteristic in a trend day. Now, if you like to trade trend days, that is what this entire strategy is about. It's about identifying a trend in a market, and we use the cumulative delta to identify a trend. At that point, we've then got two tradable opportunities, which I'll get to in a moment. Okay, how this works, where to start, is in order for the cumulative strategy to work, we need a number of different characteristics. Okay, so first off, what we need is we need to see mass participation. Okay, so we need to see quite a lot of volume. Why? Because a lot of volume tells us there's a lot of people interested in this trade. Okay, we also need to see a structural break. Why? Because when we have structural breaks, by the way, a structural break is nothing other than when we take out key areas of interest in the market. Could be support, could be a daily low, could be a weekly low, could be an area where there's a number of stops. The point is, it's a break of a key structure in the market. Now, when that happens, the reason we want to pay attention is because there's now positioning in the market. Okay, in other words, when we take out a key weekly low, there are now fresh shorts entering the market with momentum. And because they're entering those fresh shorts, those positions are now vulnerable. Why? Because short-term algorithms are designed to get onto the momentum, but they have very tight stops in place. So if all of a sudden that momentum is weak and the market starts to reverse, those same algorithms will unwind those positions. Okay, that's why things like head fakes and key auction reversals happen in the market, because all of a sudden all that net positioning, that short-term positioning, needs to unwind itself. Now, we then need a signal, and I'm going to go through all of this together. So the signal is ultimately high volume, high delta, price change, and a structural break. In other words, if I was to outline this trade strategy for you, what we're looking for is we're looking for a market to show trend. Okay, we need to see high volume, we need to see price change, we need to see delta happening in the market, and we need to see the delta ultimately accumulating as the price is trending. When we get those two scenarios together, combined, we have what we call a trend in the market, or at least a cumulative delta trend. Now, at that point, as a trader, I want to get onto that trend. Now, some traders will be trading it on the way down. Maybe they want to be shorting it there. Maybe there's Axis, okay? Of course, there are trades involved as the market is trending, and there's reasons why markets trend. Depending on your strategy type, you might be partaking in that. But if you're that kind of trader that prefers, or you don't like just getting in and taking any price, and you prefer to wait and use limit orders and be a little bit more slow to come to the market, then this is a strategy that'll be a little bit more suitable. Now, what you're waiting to do is you're waiting for the market to pull back. Now, again, for a lot of traders, this will be quite common. Yeah, the market moved down and pulled back and gave me an entry. That's ultimately why I'm showing you the strategy, because it is a way to enter trend-like moves, but to use access to do it. Now, what typically happens is there's two tradable opportunities here. One is the first pullback. The other opportunity is if that first pullback breaks, in other words, we get in, we try and get on the trend, but it then breaks, we're actually going to cut and reverse the trade. towards the upside. Why? Because of that short-term accumulative delta unwind. And that's ultimately how the strategy works, is we want to get with the trend. We want to stay with the trend of the market. We don't want to presume the market's just going to reverse. So we're going to wait for the market to pull back, and I'm going to show you how you enter this with access. But ultimately, if it doesn't continue with the trend, we know because of that cumulative delta positioning that we can then partake to the other side of the market. Okay, sounds pretty logical, doesn't it? There's two tradable opportunities here. If I lose on the first one, so what? I'll cut and reverse and try and make the losses back on the second one. Now, by the way, it's not to say you won't cut and reverse and cut and reverse. You can lose twice in this, of course. The point is that there are tradable opportunities when we have this thing called cumulative delta. Okay, now, the first opportunity we're looking for is we need to wait for some form of a relative pullback. Now, this is the only time you'll ever hear me talk about Fibonacci retracements. Fibonacci retracement is not a tool I'd advise you to build strategies off. Okay, what makes a Fibonacci tool very, very effective is the following. If, for example, this is how the market moves, and I put a Fibonacci from there to there, and it pulls back to 25%, I know on a relative basis the market's pulled back 25%. It makes nice mathematical logic to me. If it pulls back 50%, I can start to visualize, okay, it's pulled back half the way. If it pulls back 100%, cool, it's pulled back 100%. That's where a Fibonacci tool is great. It puts things into relative perspective. Because if I want to get on a trend and the market pulls back 5%, that's pretty aggressive. The market sold off quite a lot. It's probably oversold. Do I really want to be getting in after a 5% pullback? Probably not. Okay, so it gives us a bit of perspective that we can lean on as a baseline tool. So for this trade, I never want to be entering in less than 25%. Okay, for the simple reason that for this trade to work, I need to make sure that I have a risk reward between 1 to 1 and 2 to 1. Remember what I said to you? Real risk reward is not 5 to 1 or 10 to 1. I'm not looking for this trend to continue to the downside, because probabilistically, how likely is that to occur? And this is where traders sometimes go crazy. For a market to trend, pull back, and then continue trending, you're probably going to get that 0.25% of all the trading days in the year. So if you're expecting to play for that every single time you see a trend there, the reality is you're gonna leave a lot of chips on the table. Okay? Markets just don't trend all that often. But when they do trend, you need to try and make that quick, easy opportunity, get out and wait for the next opportunity. Okay, get out of this idea that a home run is a 3 to 1 or a 4 to 1 or 5 to 1. It isn't. A home run is where the odds are in my favor. I'm going for a 1 to 1, maybe a 1.5, maybe even a 2 to 1 because, you know, things are aligning, but I'm doing it with some good leverage. Okay, if you start to think like that, think about what makes an algorithm so powerful. They're taking very small winners for very small risk with a high amount of frequency. That's what makes them very profitable. Not they're taking huge winners. No, that's not what makes them profitable, because huge winners probabilistically are unlikely to occur. Okay, frame your thinking. So, what we're looking for in terms of a target is we're looking for that. Now, like I said to you, if you know that you want at least a 25% pullback, what's the target? Cool, it's 25%. Now, strip it back. I'm going to kind of oversimplify this in a very simplistic way. Let's say you didn't use any form of access, and you just kind of dumbed the strategy down. You said, when I see a cumulative delta on the day, I see high volume delta, price change, and structural break. I call that trend. In other words, there's an automated signal that says, Brannigan, this market is in a trend. Now, at that point, I go and I take a fib tool, discretionary, from the top of the trend to the bottom, and I say at 25%, I'm just going to use a limit order. Okay, so I've got a limit order there, and I enter with whatever my size is, 3 lots, 300 Apple shares, whatever it might be. And I say to myself, do you know what? This strategy, if I just took it for 1 to 1, so my stop is now at the 50%, and I'm going to target a retest of the lows, I've got a 1 to 1 strategy here. Now, when we get to the process of strategy development in a moment, this is what you have to do to develop a strategy. You have to strip things back into a simplistic way, apply a very simplistic approach, and see what the numbers look like. Okay, if you go and run this, and you can do this kind of basic analysis without too much backtesting software, if you go and run this analysis, you'll probably see that you have got a little bit of an edge in the market. Are you going to make good money out of this? No, probably not. Okay, because you're giving away a lot when you get stopped out, and more often than not, you're not always going to get the exact low tick. If you tightened it up and said, well, how about I just take 15% as a target, but keep the 25% stop, okay, you'll see your win rate improve. But what you're going to start to see is that your overall revenue over a big enough sample is going to start to decrease. Why? Because now you're not paying yourself for the risk you're taking. And you start to play around with this. Okay, now that's one way to do it. That's how you do it. By the way, if you're developing an automated strategy, that's how you play around with it. Not the easiest thing to do, by the way, automated strategies. Probably a topic for another discussion. However, now we instead are going to apply access. In other words, what we're saying to ourselves is, when we get that 25% pullback, I really want to see some form of access. Because if I can see the kind of price action I want to see, what it means is I don't need a 25% stop. And the way to think about this, let's say someone picked up the phone and said to you that I'm going to sell it at this price over here. Call it $79.20. Let's assume this is oil. Okay? And someone's now selling it at $79.20, and you can see him selling it on the screen. Okay? We all agree we would jump in front of him. We would jump in front of him because you can see he's selling it. Now, where would we place our stop? Well, we'd place the stop above him, because if it starts to get above him, clearly the selling is either done, and there's not much more coming behind him, so why would we take any more risk? Okay, and that's what access ultimately is. It's something that says to us, bang, the seller's there. I know there's a trend because I've defined the trend. The strategy is defined with a signal. I know there's a trend. The seller's in, therefore I want to sell. And I can suddenly tighten up my stop with access. Okay, which means now I'm maybe only using a 10% stop. I'm still looking for, roughly speaking, 25%. But now suddenly I'm starting to get 2.5 to 1, probably closer to 2 to 1. If you look at the real risk reward on this, you're probably looking around 1.95 to 1 if you do this enough times. Okay, who wouldn't like a strategy that pays out 1.95, a real risk reward, not hypothetical hocus pocus? That's a great strategy, 1.95 to 1. That's an amazing strategy, particularly if you can start to put some leverage on it. Then it's a really good strategy. But the hard work is one, I need to define that signal, the context. The second part is then, what axis am I going to use? Because I need to find an axis that's telling me there's a seller in. Now, what you'll see in a moment when we go to these tools called strategy cards, certain access works better in certain trade contexts, and you have to play with this. Okay, it's something you work with. And again, there's different forms of access. Start with engulfing candle, because it's a very, very clean-cut access form that you can use. And it might be all you need. You don't need, by the way, high counter trend delta. You don't need equal and opposite long-tailed reversals. You don't need these things. They're all just different forms of access. What you need is the one that plays out time and time again that can ultimately make you profitable in the long run. Okay, so the two types of access that we use, one is the high, well, I'm going to show you two. One is the high counter trend delta. And the way to think of this, as the market pulls back, if I all of a sudden see buying delta, okay, in other words, net positive delta as the market's pulling back, what is that telling me from a delta perspective? It's telling me there's a buyer lifting big offers. Now, what am I looking for in terms of price action? I'm looking for someone to provide liquidity so I can get short the market. So if I see a high counter trend delta, okay, because obviously this pattern can go to the upside as well. In other words, if I see someone lifting big offers, that's a very good reference point for me to get short. Because guess what? If someone's providing liquidity over there, he's probably got a lot more to come down the pipeline. And there's not going to be too many aggressive buyers buying that much liquidity. Okay? So the moment I can see that axis of high positive, counter trend delta, at that point I've got access to my trade, because it's signaling to me there's a seller in the market. That's the point at which I want to short. And I'll show this to you on a chart in a minute. Okay? The second one is an equal and opposite long-tailed reversal. Okay? It's a very clean-cut form of price action where the market comes in and around. Remember, we're not selling the 25% retracement. We're observing around the 25% retracement. The moment I see some form of a long-tailed reversal, again, what is that telling me? It's telling me that the market pinged up to there, sellers stepped in very quickly and started to hit the market back down. Why? Because, hey, they want to join the trend as well. We all want to join the trend. And I'm using the axis to now get involved with the market. Now, here's the catch, and here's where access methodology is so powerful. If I wait for that long-tailed reversal, where's my stop? Because you all just said it a moment ago. You all just said, my friend told me he's selling the market, therefore, if it trades above where he said he's selling the market, well, I want to get out. It's the same with access. Okay, if I define this as the moment sellers are entering the market in the pullback of an uptrend, well, then my stop just simply goes above where those sellers are entering the market. Because if they start to trade back up above there, what is it telling me about the strength of the selling? It's telling me that it's actually not that strong. Right? Because if this is a very aggressive trend, and if everyone wants to get on this trend because, hey, we're having a party to the downside, well, then I don't really want to see the market trade back up there. Okay? So we have a very tight stop because now suddenly, there's your stop. The stop is where the trade is invalid. The stop is where those sellers are no longer showing strength in numbers. Where's the target? Well, I told you where the target is. So what we can see is that suddenly, let's call this oil, let's call it 15 to 20 ticks because, hey, we're not going to get in there. That's not where we're getting in. We're going to have to enter in once that axis is confirmed. We're going to be entering in there. We short the market. There's our stop, 15 to 20 prices. And what we've got now on the downside is 40 prices, 45 prices, 35 prices. Not sexy though. Only 1.5 to 1, 2 to 1. It's not great, but it's high probability. That's what we're after. You play this pattern enough times with access, you're going to be winning this more often than not. Okay? Now, yes, there are times the market's going to continue trending. So what? Who cares? Your job as a trader is not to call the trend. Your job as a trader is not to make 5 to 1. Your job as a trader is to understand structure that exists and apply yourself with a methodology that's repeatable. Boring? I get that. Okay, I want to sell the S&P and make 5%. Of course I do, because then I can tell everyone how good I am as a trader. The reality is that boring is what will put money in your bank account. And that's our objective. Our objective is to be profitable. Our objective is to be consistent. Now, when we apply this, can we all agree that to define this signal is precise? And I'm going to show you how precise it is when we get to part 4, when I show you how to automate your signaling. Because if we have a precise signal, I just told you, we have a precise approach to executing that signal or that structure, which is wait for 25%, wait for access. When the access occurs, we put the stop there. We look for a marginal target. Is there any discretion involved here? No. All the planning is done pre-risk. All the analysis is done post-risk. During the course of the day, all I'm doing is, hey, I know this pattern. Hey, I know that axis. Hey, there's that characteristic I really like to see. Oh, cool. I made 1.5 to 1. Move on to the next opportunity. That's trading 101.